When you look at the stock market, it's difficult to understand why each stock is priced in such way. I mean, look at we all have heard the news that Apple, in the first $1 trillion company, it world's biggest and the most successful company. Maybe the stock's price should be higher as well, right? Not really. The reality is quite different. Apple's stock's price right now is $258, while the company that is hundreds of the times smaller than the NVR Incorporate has stock price of $3,000. Does it mean the NVR Incorporate is bigger than Apple? The short answer is no. However, a little a bit more complicated than it might seem. In fact, the entire stock market seems quite complicated at a first look, but there is the logic explanations behind most of the things. To make a seem out of the stocks market, we have to understand that a stock is the first place. Let's say for the last 6 months you have been thinking of starting the business. The only problem you have is you don't know what businesses to start. One day on your way to college, the idea strikes your mind. You pull out your phone and write it down. You rush your house and start planning. Everything looks perfect. You know how to turn the idea into the multi-billion-dollar company. Congrats. But it's too early to celebrate because you don't have the capital to start. You gather your family members and you explain to them the idea, hoping that they will invest in the company. Everyone thinks you are crazy except your uncle who decided to bet on you. $10,000 in the exchange of the 20% of the company. It might seem much, but in the actually a lot. $10,000 in exchange for the 20% of the company. It might not seem much, but it's actually a lot. Because your Archon just valued your idea that's not proven yet at $50,000. So you register your company, issue $100,000 shares, and your Archon gets $20,000 of them. You start building your website and designing your products. A few months you run out of the cash, and you need to raise more money. Unlike last time where you simply had an idea, now you have the concept to present. So instead of going to your uncle again, you can do something different, like taking to some of the big guys, such as the alien investors. Angel investors are usually the rich dudes who are looking for the innovative ideas of the young entrepreneurs to invest in. Something is sharks in the Shark Tank. It's not easy to convince these guys to throw money into your businesses because statistically 9 out of the 10 businesses falls, and you have to prove them why you are exceptions. They, after the talking multiple angel investors, luckily you could get one of them on the board. But first you have to agree on the some valuations. There is the pre-money valuations and post-money valuations. It's not difficult as it sounds. Pre-money valuations is how you value the company before receiving the investments, and post-money valuation is the pre-money valuation plus the investments. The higher the pre-money valuations, the less portions of the company the investors is going to take. You enter into the negotiations that you convince the investor to throw $1 million into your businesses with $2 million post-money valuations. So the investor is going to take 50% of the company, and your shares will be diluted together with your uncle ones. That doesn't mean you are going to have fewer shares. The company will simply issue another 100,000 shares for the investors. So how they are the total 200k shares instead of the 100k shares, and your stake is 40% since you own 80,000 shares and your uncle's is shares is 10%. With the $1 million that you rent an office, hire some designers, engineers, and specialists to complete your products. Finally, everything is ready. You are about to launch your products, apps, services, whatever, but guess what? You are out of the cash. And you still need marketing budget and sales people, so you decided to raise some more money. You go for the Series B. This time you meet some VSS or venture capitalists. They are not your typical angel investor. These dudes with MBAs and work in the venture capitalist firms who take other people's money and invest in the companies such as yours. Always after the multiple negotiations, they decided to bet on you. Since you already have the team and the products to launch, your company hopefully now worth more. Let's say the venture capitalists offer you a $10 million investments with a $20 million post-money valuations. You find that offer fair and you accept it. The company issue another 200,000 shares and everyone's stake gets diluted again. Since the venture capitalists just purchased 50% of the company, your 20% Uncle Fives angel investor 25. In case you are wondering, no one has lost money so far. In fact, everyone just got wealthier. The angel investor, for example, had 50% of the $2 million when they invested in the company. Now he has 25% of the company that worth $20 million, which is $5 million. In fact, your stake worth now $4 million. Anyways, you can go for the Series C, D, and so on. A few years have passed. Congrats, you have made it. Your idea turns out to be successful. Your business is finally making money. Remember, everyone who has invested in your company has been waiting for you to grow big enough to stay they can cash out. Especially your uncle, who is $10,000 investments now worth millions. You have two options. You either get sold to one of the giant of the industry like Instagram did, or you go public like a Facebook. And it's known like IPO, initial public offering. It's just another way to raise funds and issue shares, but this time anyone can buy your shares. They are open to the public, to your uncle or the agent investors can sell their shares and make a fortune. In fact, people can buy and sell your shares among themselves in the stock market. So before going public, the stock's price is determined by what you and the investors would agree on. But after going public, the number of the factors would influence the price slightly change. The laws of demand and supply would determine the price. Stock price after going public. Facebook went public in May 2012 and $38 per share, valuing the company at $104 billion. But the public didn't agree with the Facebook, so the demand for the Facebook shares wasn't as high as the supply. Therefore, in the IPO, the stock's price dropped to $18 a share, but Facebook still managed to sell enough shares to raise $16 billion and make it one of the largest IPOs in the country. The price of the stocks doesn't accurately press the true value of the company because the number of the factors that can influence it the demand and supply of the certain stocks are just too many. Let's just say hypothetical some kind of the disease would spread around the world that would push the media to talk and exchange about how the disease could crash the economy. That would scare off immature investors and would push them to sell their stocks before the market would go down, as the media say. So the supply of the certain stocks, let's say Facebook, would be much higher than the demand for it in the market, which would push the price plummet. And that could scare off the rest of the investors and push them to sell their shares as well before it drops even further. Even though this particular disease is anyway isn't affecting Facebook's, it still force its stock's price is drop significantly. Here is another example. The company might realize its earnings for the last quarter and they might not meet the expectations slightly. That could get some negative press, and negative press could easily push some investors, especially immature ones, to sell their shares, and that would increase the supply of the shares and would drive the price down and even scare of more professional investor. It is never ending cycle. That's why the panic over the crisis can destroy the economy. The company might not be making a profit for years or decades, but because it seems like sometime in the future it's going to make a lot of the money, investors would keep buying its shares, hoping that one day it's still going to pay back, and that hope would keep price rising, like in the case of Amazon. It didn't make a profit for 20 years, and yet it made Bezos the richest man in the world. If company would keep doing great, the stock price could rise in the unbelievable amount. Berkshire Hathaway's stock price peaked at $340,000 a share in February. Yes, you heard it right. Single stocks cost $340,000. It's what it takes to invest in the Warren Buffett's company. So some companies play around with their stocks to increase the demand for the stocks by splitting their stocks, for example, to keep them attractive even to the small investors. Take an example of the Apple's. The stock's price currently is $247, but did you know that in the June 2014 it was $649? That doesn't make sense, right? Because the company doubles the market capitalizations and iPhone sales skyrockets since then. Then what does this supposed to mean? Let me explain. In 2014, Apple split its stocks 7-1. It's in simple words, Apple divided each stocks to 7 stocks. So the stock's price dropped to the $92.7. So if you had one Apple stocks back then and cost $650, now you have 7 stocks and each of them cost $92. Nothing really changed, but the stock seems more affordable now, which increases the demand for them. Hence, the price would rise as well. The number of the factors that could influence the stock's price are way more than we can possibly cover in this video. But here is the catch. The trick is to find out if the price of the stocks does really represent the true value of the company. If it's overvalued, it doesn't not worth investing, because sooner or later the price if the stocks will drop to its real value. On the other hand, if the stock's price is lower than that, the company really worth, then it is the great investments. Since the stock's price sooner or later will rise to its real value. I hope you guys have enjoyed this video. Make sure you give this video the thumbs up and leave the comment, because that will really help the channel. And of course, hit the subscribe button if you are new around here. Thanks for watching, and until next time.